Wait, did the US and China just end the trade war? Or have they silently kicked off the next global financial battlefield? Because here's what the headlines scream everywhere. Trade deal signed. Markets are soaring. Investors are cheering. But hold on, take a breath. Because something doesn't add up. Tariffs, still sky high. Nike, already warning of massive price hikes. President Trump just stormed out on Canada over a digital services tax, mid-negotiation. So now the real question becomes, is this shiny new peace deal actually good for the global economy? Or is it quietly laying the groundwork for soaring inflation, a new recession, a massive shift in trade power in global markets? And most importantly, how do you protect your money, grow your investments, and prepare before this storm gets real? Let's break this down, clearly, calmly, and honestly. The deal signed, but did anyone read the fine print? Let's rewind the tape, just a bit. Before the trade war, the US had a modest 3% average tariff on Chinese goods. China, about 8% on US imports, not perfect, but manageable. Then came the Trump-era trade war. Tariffs exploded. The US raised tariffs to a whopping 19.5%. China fired back, with equally aggressive counter-tariffs. A classic economic chess match, and no one was winning. Now, after months of tension, we get what looks like a deal. A headline that screams peace, but let's look closer. The new US tariff rate? 30% on Chinese imports. China's response? Still holding firm at 10%. That's not peace, that's not even a compromise, that's just tension repackaged, negotiated chaos with a prettier bow. But then, why are investors celebrating? It's strange, right? Markets are soaring. The S&P 500 broke records, NASDAQ and Dow, both climbing fast. Why the celebration? Because in investing, clarity is king. It's not about whether the deal is good, it's about whether the market understands the rules of the game. This deal, even with all its flaws, gave the market something it desperately craved: structure, numbers, time frames. And when markets feel like they understand the landscape, they feel confident enough to play, even if the playing field is still dangerous. But the corporates, they're sounding the alarm. Let's talk Nike. They just dropped a brutal warning. We're running out of pre-tariff inventory. When it's gone, prices are going up. That's not small talk. That's nearly $1 billion in additional costs, just from tariffs. And if Nike's hurting, think bigger. Apple, with its massive China supply chain, Amazon, relying on global imports, tech manufacturers, retailers selling school supplies, groceries, clothing. This won't just hit luxury items, it'll hit everyday essentials. Clothes, school books, groceries, tools. In short, life is about to get more expensive. And the most dangerous detail no one's mentioning, here's the ticking time bomb. This deal, it's not even permanent. It's a 90-day pause. That's it. Just a pause. It expires on July 9th. That means everything you're seeing in the news right now, every market rally, every deal celebration, every press conference, it's all temporary. If talks collapse, new tariffs can hit instantly. Trade relations could crumble. Market optimism could flip into panic overnight. What should you be doing right now? Okay, enough theory. Let's talk real strategy. Because if you're sitting on all cash, risky. All in on growth stocks, also risky. You need a balanced inflation-smart plan. Let's go step by step. Step 1. Hedge against inflation. The right way, forget guessing games. Focus on protection. Treasury. Inflation-protected securities. Tips. Gold, oil, and commodity-based ETFs. Real estate investment trusts, REITs, with strong cash flows. These aren't hype plays. They're defensive shields for economic storms. Step 2. Invest in companies with pricing power. Look for companies that don't lose customers, even when they raise prices. Examples? Consumer staples, food, hygiene, home goods, healthcare giants, Pfizer, J&J, big retailers, Walmart, Target, Costco, energy leaders, ExxonMobil, Chevron. These companies survive inflation because they own the demand. Step 3. Keep some cash. For the storm, volatility isn't gone. It's just waiting. When July hits, new news could shake the markets. Smart investors, keep 10-20% cash ready, not for hoarding, but for buying the dip in strong companies. It's not timing the market, it's preparing for the inevitable swing. Let's break down what wealth managers are doing. They're using a 3-bucket system: 1 defensive core, blue chip stocks, plus bonds; 2 inflation, hedge, tips, gold, oil; 3 opportunity cash, for short-term dips. This isn't panic investing, it's long-term chess, and right now, the board is moving. This isn't just a policy change, it's not even just a trade reset. It's a global economic pivot. Trade power is shifting. Market behavior is changing. Pricing psychology is evolving. This is the chapter where entire industries adapt. And the people who understand that, they're the ones who build wealth, and while others panic. So I'll ask again, are you just watching from the sidelines? Or are you planning for what comes next? Because the next 12 months, they will reward the informed and punish the passive. Like this video if it gave you clarity. Subscribe if you want more breakdowns without the hype or fear-mongering. Drop a comment. Are you shifting your strategy, holding cash, or just watching this unfold? Because here's the truth. We're not in a peace era. We're in a reset era. Don't guess your way through it. Plan your way through it. You've already taken the first step by watching this. Now, let's take the next one together.